Look at the charts, right?
Sure.
How overextended are we when it comes to the FANG names? FANG.
Historically, they're not as stretched as you think right here. This doesn't even compare to what we saw in '99. And also, this is a broader move. This is not just 4 or 5 stocks working in tech. This is big caps, it's mid caps, it's small caps. So there's more behind the move than just the FANG stocks working. And you pick on a stock like Apple. I think people forget Apple went through a pretty severe bear market last year. Stock was down 30% for most of 2016. This is a relatively new advance. I still think we'd want to use any summer weakness opportunistically here. This is a good group of stocks. It's still leadership. I don't want to back away from it here yet.
We have Goldman Sachs saying that Apple is the most underweight holding across large cap mutual funds on average. So how much more positioning can be added?
So I get that sense as well in my meetings with clients. It's not a stock that people hold the benchmark weighting of. I think it's 4.5% of the S&P 500 here. I'd be surprised if it's even half a weight for a lot of the street here. So these are still under-owned, which I think is interesting in the context of how good they've been. The NASDAQ 100 has had 44 record closes this year, trailing only 1999 when it had 61 record closes. So we're chasing 61 here. I think we're going to get it.
Peter, what do you make of my hypothesis earlier, that it's not about growth necessarily, it's about these companies aren't leveraged and investors are getting skittish about it?
I think investors have been skittish about it. I think that's why the chart's kind of flat when other things have been going on. It's something I'm starting to turn my attention to. A lot of these companies have kind of very broken charts, so the stocks are well down. You start looking at it, the credits are actually doing well. The bond spreads have been tightening, so I think some real upside is in some of these names, where you look at the debt cap structure, it's a large debt cap structure, credit's performing well, that should translate nicely into levered returns for the equity. I think maybe there's too much fear from last year with Valiant and the year before, KMI, that maybe people are reluctant or watching this credit story and not buying into it. I think there's a lot of upside in those types of stocks. I would look for baskets of those types of stocks and maybe make a 6-month to 1-year bet. You're going to have some volatility. There's more downside. They don't have good charts. But if they turn, you could get those 25 to 50% type returns.
So, Chris,